The AI Reality Check: Why Tech Tanked While Coke Soared. Welcome to today's Executive Market Debrief. We are skipping the pleasantries right now because, honestly, the market just delivered a massive wake-up call right ahead of the Federal Reserve meeting, and we need to break down exactly what just happened. Okay, let's dive into this macro snapshot. As you can clearly see, we're looking at widespread selling across the major averages today. The S&P 500 fell nearly 0.5%, the Dow slipped just a bit, but man, the Nasdaq took the absolute brunt of the hit, down almost a full percent to close at 24,663. So what we are seeing here is Wall Street hitting the brakes and hitting them hard. With Brent crude oil climbing on escalating geopolitical supply fears, tech jitters are taking over and inflation anxiety is really reigniting, right as the Fed kicks off its two-day policy meeting.
And this perfectly illustrates the major macro shift we witnessed today. Institutional capital didn't just, sit on its hands waiting for the Fed. No, it actively rotated out of highly volatile, high-beta tech names and sought immediate shelter in defensive, dividend-paying staples. Let's be clear, this wasn't a day for retail traders buying the dip. This was a calculated move by institutions eager to lock in profits before the next huge wave of mega-cap earnings hits the wire. Capital is actively seeking safety and predictability right now.
Part 2. The Deep Dive. Number 1. Nvidia, the AI software sneeze.
Looking at the move here, Nvidia closed down 1.61% at $213.13. Now, a 1.5% drop might not sound catastrophic in isolation, right? But Nvidia acted as the primary anchor today. This single stock dragged down the entire broader semiconductor sector, effectively pulling the Nasdaq down right along with it.
So, the crucial point is exactly why this happened. And interestingly, it actually wasn't because of anything Nvidia did wrong in its own execution. The real trigger? A Wall Street Journal report claiming that OpenAI missed its internal targets for both user growth and revenue. Now, think about the fundamental math the market is frantically doing right now. Nvidia designs the specialized chips powering this whole generative AI arms race, right? But if the premier software company, OpenAI, is struggling to monetize at the expected velocity, well, then the massive corporate spending on Nvidia's AI infrastructure could eventually stall out. It's just a classic shoot first, ask questions later reaction from a market that has priced AI hardware for absolute perfection. Basically, Nvidia showed Wall Street today that when the software layer sneezes, the entire hardware sector catches a cold. We've been valuing the infrastructure flawlessly, but if software can't justify these multi-billion-dollar data center buildouts, well, that CapEx cycle is going to hit a brick wall.
Moving to number 2, Coca-Cola, the margin masterclass.
Here is the move. Coke surged an impressive 3.86%, closing at $78.35. In a market literally painted red today, Coca-Cola stood out as the absolute top performer on the Dow, vastly outperforming the declining indices. It was a sea of red everywhere else, but not for Coke. Let's break down the fundamental driver here. While tech struggled with those monetization doubts we just talked about, Coke totally defied the gloom with a stellar Q1 earnings beat, and they confidently raised their forward guidance. But the absolute standout metric here is that unit case volume grew by 3%. Think about that for a second. In a difficult macro environment with squeezed consumer wallets and reigniting inflation fears, Coca-Cola proved its pricing power remains absolute. They are aggressively passing higher costs directly onto consumers, and demand didn't drop. It actually grew. This is exactly why institutional capital flooded into Coke today. They don't just react to margins in this environment, they explicitly dictate them. Coke proved that unquestionable brand loyalty is the ultimate defense, delivering exactly the predictability that cautious investors are absolutely demanding right now.
And number 3, United Parcel Service, the transformation penalty.
Now, UPS is a vital proxy for the overall global consumer and business economy, and let me tell you, the move here is brutal. UPS plunged nearly 4% to close at $103.94. This massive drop broke key technical support levels, and it happened on heavy institutional distribution. Basically, that means the smart money was rushing for the exits.
The fundamental driver behind this drop is incredibly nuanced, but it perfectly captures current market psychology. Notice that first point. UPS actually beat analyst forecasts. They posted an adjusted EPS of $1.07 versus the expected $1.03. But Wall Street completely ignored the beat. Why? Because investors fixated entirely on severe margin compression and $350 million in transitional costs tied to an ongoing restructuring phase. Pair that with falling domestic U.S. shipping volumes, and the message is incredibly clear. The market has absolutely zero patience to wait out an expensive transformation right now. If your margins are shrinking in this elevated rate environment, an earnings beat is not going to save you from a sell-off. UPS is paying a heavy penalty for trying to transform while the macro environment tightens.
Part 3. The water cooler angle.
Here is exactly what you should say to your colleagues tomorrow morning about your market insights.
Did you see Nvidia drag the Nasdaq down to $213 today? The WSJ report about OpenAI missing its internal revenue targets is a massive wake-up call for our tech allocations. We've been pricing AI hardware for absolute perfection, but if the software layer can't monetize fast enough to justify these massive data center buildouts, the CapEx cycle is going to hit a wall. It's a great reminder to trim some of our tech exposure right before the Fed makes its rate decision.
Coke, jumping nearly 4% up to $78.35, is an absolute masterclass in pricing power. They are aggressively passing costs straight to the consumer, unit volume still grew by 3%, and they beat estimates across the board. When the macro environment gets this choppy with oil spiking and tech faltering, we need to make sure we're overweight on defensive staples that can explicitly dictate their margins rather than react to them.
UPS dropping 4% down to $104 is a really telling macro story. They actually beat on EPS, but the street completely focused on the margin compression, the $350 million in transitional costs, and the falling domestic volume. It shows how little patience institutional capital has for transformation years right now. If your margins are shrinking in this rate environment, the market will punish you immediately.
Coca-Cola surged to new heights today while the rest of the market flashed red. With oil climbing and the Fed meeting tomorrow, are you rotating into defensive dividend names like Coke? Or are you buying the dip on tech? Comment below. Subscribe to Market Fluency for your daily edge.